There's a number that spiked to 82 in March 2020, and almost nobody watching the news that week knew what it meant or that it was quietly telling them the crash was already priced in. That number is the VIX. Most people know it as the fear index, but the real signal isn't the VIX itself. It's the shape of something underneath it that almost nobody looks at. And when that shape flips, it's one of the most reliable warnings in markets. The VIX measures expected volatility in the S&P 500 over the next 30 days, derived from options prices, but the VIX isn't just one number. It's actually calculated at multiple future dates, 30 days out, 60 days out, 90 days out, and beyond. Plot those points together and you get what's called the VIX term structure. Think of it like a weather forecast that doesn't just predict tomorrow, it predicts the next 10 days too. Most of the time, the forecast says, it's calm now, but further out, who knows? Let's price in a little more uncertainty. That's the normal state. It's called contango. Near-term volatility expectations sit lower than longer-term ones, and the curve slopes upward. But sometimes that forecast flips completely upside down. And when it does, it's not just unusual. It's historically lined up with some of the worst weeks in market history. When near-term fear spikes higher than long-term fear, the curve inverts. This is called backwardation. It means traders are paying up for protection right now, today, more than they're willing to pay for protection 6 months from now, because the danger feels immediate, not theoretical. This happened in February 2018 during the Volmageddon event, and again in March 2020 as COVID lockdowns began. In both cases, the term structure flipped into backwardation right as markets were already falling apart. Here's the part most retail traders never connect. This isn't just a panic gauge. It's actually the mechanism quietly draining money from a popular trade millions of people don't realize they're in. Volatility ETFs and ETNs, like products tracking VIX futures, are built on this term structure. In normal contango conditions, these funds are forced to sell low and buy high every single month just to roll their contracts forward, bleeding value over time. When backwardation hits, that dynamic reverses, briefly rewarding the few holding before the flip. For everyday investors, the real takeaway isn't to trade volatility directly. It's to watch the curve as a sentiment thermometer. A shift into backwardation doesn't predict the future, but it confirms that professional money is already treating the present as more dangerous than the future. The VIX number itself is just a headline. The term structure is the real conversation happening underneath it, between traders who are calm about tomorrow and traders who are scared of today. When that conversation flips, the market is telling you something it usually keeps quiet. But fear has a price, and there's a whole hidden market built on trading it before it even happens. That's next.